Have you just inherited an IRA? Or perhaps you've come to us or another financial advisor and you're just naming the beneficiaries on your IRA or your 401k. And so we have a general rule of thumb: be smart about the income tax. This is serious business. And after the Secure Act, not all beneficiaries are treated the same. So we're making this thing for two groups of people, which I'm assuming that you are either one of them. Number one is for your own IRA and doing your planning and who you're going to leave as the beneficiaries and what the tax implications are going to be. The other one is you've just inherited an IRA or you're about to, and you want to know how you go about paying taxes on the thing and making distributions. And I want to bring Tom on. I want Tom to talk about really why we're doing this video.
Yeah, I mean, we're doing this video because these rules are important. And if you don't know these rules, if you don't follow these rules, you're going to end up potentially paying more in taxes than you need to. And so, if you're the owner of the IRA, you need to know what happens when this goes to the next generation. And these rules, like I said, they're different for each person. You need to know who they are. And you've worked really hard to not pay taxes on this money. And if you don't know what this is, how these work, you could end up paying a lot back in taxes. And if you are the person inheriting the IRA, you need to know these rules too, because your parents, presumably, or whoever gave it to you, they worked hard to not pay taxes, and you might blow it and you might pay a lot more in taxes than you have to. So you need to know how this works. You need to know these rules. You need to know what category you fall into or your heirs fall into, and do some smart planning around that. I'll make one other point, and this is just sort of overarching this whole video, is IRAs, 401ks were never intended as a way to pass on wealth to the next generation. They are not a good legacy tool. Now, they get used that way often, so I'm not saying that's necessarily a bad thing. But if you look at these rules, it's pretty clear that this is not the most efficient way to give money to the next generation. So again, we can help you with that, but we'll get back to this video. So before we do that, let me bring up the show notes. These are at the link below our video. They're also on our website under the show notes section. We have the board. A lot of people print this out so they can see it a little bit clearer, because if you're watching on the phone, this is kind of small. And then we have several charts that we use in our practice every day. This is the chart to determine if you do inherit this, and we'll talk about who has to use this chart. But if you're inheriting an IRA, this is how you determine your RMD amount, what you have to take out each year. The next chart is spousal beneficiaries. This is a different video, but just know spousal beneficiaries, they're a whole different category, kind of separated. We'll point that out as we go along. And then this one, this is really where we got the board from. This gives you a little more detail that's on the board, but it really walks through the different types of beneficiaries that exist now. Like Hans said, not everyone is created equally. So let's turn it back to Hans. We'll bring up the board and we'll go through this.
Okay, so the Secure Act, which was passed in 2019, it became law in 2020, and then it got revised in 2022 under Secure Act 2.0. And so you don't need to know all of that. You just really need to know, for an inherited IRA, if a person died in 2019 or before, if the IRA owner died 2019 or before, then they fall into the old laws. Those were grandfathered in the old stretch laws. For any deaths 2020 or after, they fall under the new law. Beneficiaries fall under the new laws. And the new law we've got outlined on the board, and we're going to go through this. So your very first step in, if you just inherited an IRA, is to determine which of the three categories of beneficiary you are. And if you're that person that's planning the distribution of your IRA, so you're watching this video, you have an IRA and you're leaving it to your spouse and then to your kids, then you need to determine which of these beneficiaries your children are going to be. And that way you can plan out the taxes, and we'll be glad to help you with that. We work in 50 states and the District of Columbia. We're licensed in all those states, and we can certainly help you out by phone or by Zoom. Now, what I want to tell you is the first category of beneficiary, the first type of beneficiary, is the non-designated beneficiary. And the first thing for you to know is these are not people. So generally speaking, it's not a good idea to put down the estate as the beneficiary of your IRA. Because if you do that, or to put down a trust, unless we've done other videos, we're going to do future videos on a see-through trust. So there is a way to create a trust or to set up a trust and leave the money in trust that's for coming out of the IRA. But boy, you need to come to professionals for that. So when you just leave the estate or leave a trust and don't do the proper planning, they're going to end up getting thrown into this category. And so this is an estate, a charity, a non-look-through trust. Okay. And the reason you don't want to do this is this is the most limited terms. It's 5 years that the trust or the estate has got to distribute the money, and they're going to have to pay taxes at trust rate. You just want to avoid this unless it's at all possible, with the exception of charity. If you leave it to a charity, then the charity's not going to pay taxes on it. So it's just, and the charity is going to be considered a non-designated beneficiary, and they can just distribute all of it and not have any tax bill. But other than that, these are not people. That's the simplest way to do it. And so when you leave your IRA to beneficiaries, which are named people, they're either going to be in category number 2 or category number 3. And what category number 2 is what they call the non-eligible designated beneficiary. And the terminology is real confusing, but this is really, they're going to start with people that don't fall under the exceptions. Okay, so when they pass the Secure Act, number 3 is pretty close. The eligible designated beneficiary is pretty close to what everybody used to get. Is you can stretch, your beneficiary. If you are the beneficiary, you can stretch these things out over your lifetime or your life expectancy, and consequently make them lower and have a lower tax effect. Everybody used to get that. And under the Secure Act, what the big change is they're saying that if you don't fall in one of these special categories, you're going to have to stretch the thing out over a maximum of 10 years. Or another way to put it, you can leave it all in there until the 10th year and then pull it all out in the 10th year, which probably wouldn't be very smart tax-wise. But it's just, they put in a 10-year rule. So the IRS wants their money. I mean, it just boils down to, and that's by the passing of the Secure Act, they're saying, look, if we have a non-eligible designated beneficiary, which is everybody else but the special categories, then we're going to get our tax money within 10 years of the death of the person. And then they threw another little ringer in there that we're not going to go over today, but if you're the deceased IRA owner was 73 or older when they died, you're actually going to have to go to that chart that Tom was showing you earlier that's in the show notes, and you're actually going to have to start taking some small deductions during the first 9 years. So I don't want to get into a bunch of details here. I really want to just get the point across that if you're not a person, or the beneficiary is not a person, they're going to fall under a 5-year distribution rule. If you're a person, like if it's you're a real live person, you're either going to be in number 2 or number 3. And if you're in number 2, which is everybody but number 3, you're going to have to stretch the distributions out over 10 years and have the whole IRA emptied by the end of the 10th year. If you're in number 3, you're what's called an eligible designated beneficiary, and you're going to get the benefit of stretching it out over your life expectancy. And the place, well, I'm sure there's several places where we use this, but most effectively, it's with the chronically ill individuals or the disabled individuals. We do a lot of special needs planning here at Cardinal. People all over the country where people are in their 60s or 70s, and they have that special needs child who's living with them. And that child is the beneficiary of the IRA, and big problems when they die, because if that child takes distributions out of a sizable IRA, they're going to get disqualified for all their government benefits. So we set up special needs trusts, and then we also set up an IRA see-through trust for an eligible designated beneficiary. So special needs children fall under disabled or chronically ill. Um, I mean, it's a question of the definition, but there's this category of people who can stretch the payments out over their lifetime. And those are the surviving spouse, and the surviving spouse gets the best treatment of anybody, or the most favorable tax treatment, RMD rules, and the surviving spouse can actually retitle the IRA in their own name, and then it becomes theirs, and it's not an inherited IRA any longer. Now, I don't want you to just run out and do that. There's a lot of checking that needs to be done to see whether that's advantageous, but the surviving spouse is an eligible designated beneficiary. Minor children of the account owner. So, and that's not grandchildren, it's minor children of the account owner can then stretch these payments out over their lifetime. But then that ends when they get to 21 or say 18 in some states. Chronically ill individuals. So if you leave it to your sister and your sister is chronically ill, which means she can't do 2 of the 6 activities of daily living, or she's cognitively impaired, she will be able to stretch the thing out over her lifetime. Individuals not more than 10 years younger than the IRA owner, we've had an example of this, where we had this gentleman who inherited several $1,000,000 from his sister, who was only 1 year older, in an IRA. And the several $1,000,000, he went to the advisor that sold her sister stocks, and it was the financial advisor, and he told him 10 years. So this several $1,000,000 had to be all distributed over 10 years. And that makes a big tax bill every year for 10 years. And when he came to us for help, we picked up on that right away, that he's not more than 10 years younger than his sister was. And so he's an eligible designated beneficiary. And because he was like 66 years old, we looked it up. It's 21 years is his life expectancy at this point. So he can spread that several $1,000,000 IRA distribution with RMDs over 21 years. And what we prepared for him was an annuity that pays him an exact amount every month for 21 years. And he's never going to have to think about it again. And he just gets a check every month. And he's all satisfied. But that was a big difference. Stretching it out over 21 years instead of 10 years, cut him by more than half. So really, when it boils down to, if you're the inheritor, you need to determine which category you are. And if you're under the 10-year rule and you're in number 2, then you're going to follow that. And we've got other videos on how the 10-year rule works, so we're not going to get into details about that. If you fall under the eligible designated beneficiary, then you're going to go to that chart. I recommend you go to a professional that knows what they're doing and use that chart, and then stretch the distributions out over the period of time, as long as it's longer than 10 years. And we can help you with that. We can even set up a product of annuity payments that is just going to send you a check, and you're just qualified for the thing right from the start. So I'd like to bring Tom back on, and I'd like Tom to give us some thoughts on this whole subject.
Yeah, I mean, without getting into too much detail, I mean, the whole crux of this idea is you have this money in a IRA, and if you were the account owner, you haven't been taxed on that, assuming it's a traditional IRA. And so, if you're still living, one thing you might want to do is start distributing it slowly over time. Either Roth conversions are taken out, because ultimately, if you leave a large balance in an IRA, say to your kids, which is typically what happens, they now have 10 years. That 10 years can be, some of them take it more quickly than that. But now that really accelerates the distributions that have to come out of it. driving them up into higher tax brackets, causing them to pay more taxes. And so you did this great job of deferring the taxes to have a lot of it be sent back to the IRS or the state government if you live in a state that has income tax, and they don't get to keep it. They don't actually inherit that full money. And so, just IRAs in general, traditional IRAs is what I'm speaking about. Is there's the IRS has a lien against that account. You have a silent partner in there. We have lots of videos where we talk about how to handle that. But at the end of the day, you really need to think through what this looks like for the rest of your life and then for your kids' lives. And is there a more efficient way to leave them better off than maybe just leaving this big balance? Because what most people do, what you might be doing, is having this balance. You don't need it, which is great. You can live off your other money. I mean, you've done a great job to get there. But now you just have, without a plan, you're going to leave this money to the kids. They're going to have to take it out more quickly, pay a lot of taxes. A lot of that wealth you worked hard to save is gone in taxes. And so, really, what we want to do is just open your eyes to this. If you're inheriting the IRA, you need to be smart about how you distribute it. Again, call us, call someone who's a professional in this. We can help figure that out. Um, a lot of times, you want to take more than the minimum. Like if you're that non-eligible designated beneficiary category, if all you're doing is taking the minimum for that 10 years, you get to the 10th year and you have a big balance left to take out. So you've just deferred the problem, but you still have a big income hit in that final year. So you really need to be smart about how you distribute it. So call us, call someone else. You really need to have a plan of how to handle IRAs, whether you're living and it's your IRA or you're the descendant and you've inherited an IRA. It's just important. So.
Okay. Now, the point that we left out was the very first point is traditional IRAs or Roth IRAs. And if you have a Roth IRA or you've inherited a Roth IRA, you still follow under all these distribution rules. The deal is you don't have to pay any taxes on the distribution. The IRS is just saying, you need to pull the money out of there under these criteria, but you can leave the balance in there for a certain period of time, earning more tax-free money. Or in its simplest form, if you pass a Roth IRA on to the next generation, they can let it sit there for 10 years, don't touch it, and all the growth is tax-free as well. And then at the end of the 10th year, they're going to have to draw it all out with no tax bill. So, and we have many people coming into us where they inherited a combination of the two. And so then it gets a little bit more complex. I think Tom's point was well taken that if you are inherited this money and you can't convert it to a Roth, and so you just need to be smart about the taxes. And if you're looking at this video, thinking about your own IRA and planning ahead for your kids, I think that just drawing down the traditional IRA balance over your lifetime, perhaps even just living off of it and paying the taxes bit by bit by bit, and then saving your other money because your kids are going to inherit the other money without a tax bill. So, I mean, think about that. And and there's ways that we can, besides we can look at Roth conversions for you. A lot of people create Roths for the purposes of passing on to their kids tax free. There's also a way to buy life insurance. So if you start spending that money and you still wanted to leave it, we can set up a life insurance policy that you pay a premium for, and then that'll go tax free to your kids when you pass away. So there's a lot of ways to plan around this problem if we've got a few years and some relatively healthy people applying for the thing. So I want to go over the comprehensive financial planning, what we talked about. Obviously, this whole section is about IRAs and 401ks, income. This is income for the beneficiary, estate planning, which this is a big part of the estate planning we do because a lot of people that come into us, 80% of their wealth or more is in an IRA. And so we first got a plan for them to live off of it, and then we got a plan for it to pass along. And so this is very much a topic within there, and then income taxes. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.